Welcome to the Deep Dive. If you need a fast-track summary of the key strategic takeaways from the latest earnings cycle, you are absolutely in the right place.
Today, we are focusing on TJX Companies, Inc.
Yeah.
You know, the off-price retail titan.
We're dissecting their Q3 fiscal year 2026 earnings call, and wow, the performance not only beat expectations, it sort of cemented their status as a real outlier in this choppy consumer landscape.
It really did.
Our mission here is to just quickly pull out the most valuable insights for you. We need to unpack the drivers behind their margin expansion, understand why they felt they could raise guidance.
And, crucially, analyze that strange market reaction, a company that's executing almost perfectly.
Exactly. You need to know why TJX continues to defy retail gravity.
Let's just start with the hard numbers, because they really set the stage. TJX delivered diluted earnings per share of $1.28.
Which was a clear beat. Came in about 6 cents higher than the consensus estimate.
Yeah, and the top line was just as healthy. Consolidated revenue clocked in at just over $15.1 billion.
Exceeding expectations by what, $200 or $300 million?
Roughly, yeah. But for TJX, the metric that really, dictates success is comparable sales growth.
And they smashed it.
Absolutely smashed it. Consolidated comps were up a remarkable 5%, which is an acceleration from last year.
And that strength was everywhere, right? It wasn't just one banner.
Pervasive. Marmaxx US was up 6%. TJX Canada posted an impressive 8% gain.
Okay, so stellar execution, strong beat, they raised their guidance, and yet the market reaction was, well, muted.
That's the key. The stock hit a record high in the pre-market and then just faded all day. Ended up near flat.
This is the critical tension we need to get into. The fundamentals are pristine, but the market is clearly pricing this company for absolute perfection.
Total perfection. Any hint of, not accelerating even faster is treated harshly even when they post a 5% comp.
So let's dig into how they drove that profitability. That's the real story here. The margin expansion was incredible.
Pre-tax profit margin hit 12.7%. That's an expansion of 40 basis points year over year.
And get this, that's 60 basis points above the high end of their own internal plan.
That kind of jump, it just requires surgical precision. Gross margin increased a full 100 basis points to 32.6%.
100 basis points. Wow.
Management pointed to two main levers. First, higher merchandise margin.
Meaning they're just getting better deals when they buy their inventory.
Exactly. Better buying. And second, significantly lower freight costs, which, helped everyone in retail, but TJX really maximized it.
But wait, if gross margin jumped that much, why did SG&A, the selling, general, and admin expenses, also increase by 60 basis points? Isn't that a drag?
It would be, normally.
Yeah.
But management was really clear about this. They said it was entirely deliberate and strategic.
An investment.
An investment. They chose to spend here, higher store wages, increased incentive pay because of the strong results, and a contribution to the TJX Foundation.
So they're spending money to keep the stores healthy, keep the culture strong, which they think drives traffic down the line.
That's their bet. It's a real vote of confidence in their own model.
Okay, now let's look at the customer. That 5% comp growth. Where did it come from?
It came from both higher customer transactions and a higher average basket size.
So more people walking in, and the people working in are spending more.
Right. And specifically within that basket, it was the higher average ticket, so the price per item that was the key driver.
And this is where we get that crucial insight into the consumer right now. When they were pressed on it, management noted that the lower income demographic was the primary engine of that momentum.
Right, across most of their geographies.
That immediately makes you think of the trade down narrative we hear all the time.
Of course.
If the lower income consumer is the strongest driver, doesn't that just mean TJX is a cyclical beneficiary of a tough economy, not a permanent winner?
Well, management really pushed back on that framing. They acknowledged that cohort was, I think the word they used was tipping the growth rate right now.
Tipping, not driving the whole thing.
Exactly. They stressed that performance was broad-based across all income groups. They're getting value seekers from everywhere, whether it's an affluent customer hunting for a deal or a budget customer who needs lower prices.
Opportunistic, not dependent. I like that.
And that leads right into their inventory buying. Management was very pleased, citing excellent global availability of branded merchandise this quarter.
Which means other retailers are struggling, and TJX can swoop in.
That's the model. And it led to a really important tactical choice. Their total inventory was up 12%.
12%. That sounds high.
It does, but it's 8% on a per-store basis. And this wasn't a mistake. It was an intentional build.
So they're loading up for the holidays.
They're loading up, they're capitalizing on all these great off-price buying opportunities to create that wide, eclectic assortment you need for strong holiday gifting. They are profiting from other vendors' pain.
This intentional positioning, it brings us to the guidance update. They significantly raised the full-year bar.
They did. Full-year comparable sales guidance was raised to plus 4%, up from 3% before.
And EPS.
Full-year EPS guidance went up to a range of $4.63 to $4.66. That projects a really healthy 9% year-over-year growth.
But hold on. If they had such strong Q3 momentum and they're building all this inventory for the holidays, why is the Q4 comp guidance set so conservatively at just plus 2 to 3%?
That is the question.
It seems like an easy target to beat.
It absolutely sets the stage for potential upside. This company historically underguides and overdelivers. With that heavy tactical inventory build position for the holidays, that low Q4 bar looks highly beatable.
It's a deliberate strategy. Manage expectations.
Exactly. Keep beating them.
Okay, what about macro risks? They talked about tariffs, which is always a headwind for importers.
Their confidence level here is just unwavering. They assume the current U.S. tariffs will stay, but they reiterated their ability to fully offset that pressure. Through global sourcing diversification and their pricing strategies, they basically pointed to Q3 as proof, saying, look, we did it this quarter, we can keep doing it without hurting margins.
This all speaks to a much broader strategic vision. They're not just playing defense.
Not at all. They're focused on massive long-term expansion. They confirmed their plan to grow their global store count towards a potential of 7,000 locations.
7,000. What are they at now?
Just under 5,200. So there's a huge runway.
When you connect all this to the bigger picture, I mean, TJX is just a categorical winner.
No question. While big box retailers and department stores are struggling with declining comps and cautious outlooks, TJX is structurally benefiting.
The performance gap is stark. They delivered what? Over 20 points of relative outperformance versus the broader retail ETF XRT over the last year.
Over 20 points of alpha. It's a huge gap.
And finally, a quick touch on technology. AI came up in the Q&A.
It always does now. They confirm they're aggressively testing it for efficiencies. Think fraud detection, streamlining HR, marketing optimization, that sort of thing.
But they were careful.
Very careful to set boundaries. They stress caution, specifically saying they would not compromise the human element, the secret sauce of their merchant buying and allocation.
The treasure hunt model still needs a human treasure hunter.
That's what they believe.
Okay. As always, let us be completely explicit. This next section is a purely speculative thought experiment. It's based on the dynamics we saw on the call and should absolutely not be construed as investment advice.
Not financial advice. The key dynamic here is all about expectation management. The stock is priced for zero mistakes. We saw that with the intraday fade.
Right. And the remaining friction point is that conservative Q4 guidance. Comps at plus 2 to 3%.
Especially given that highly favorable inventory position we just talked about.
So our thesis is that their ability to scoop up value from struggling vendors, combined with the consumer's endless search for value, just makes that Q4 guide too low.
They are set up for a significant holiday beat, and their structural outperformance versus peers, say like a Target, is going to continue.
Okay, so what's the plausible but aggressive trade idea?
It would be something like a long-dated, maybe 6-month call spread centered around $165.
So you're betting that a successful holiday execution drives the shares past that resistance level we saw during the post-earnings peak.
Precisely. That big opportunistic inventory cushion minimizes the risk of a Q4 disappointment, and, it makes that target highly achievable in our view.
That's a bet on consistency and capitalizing on vendor pain for the next couple of quarters.
That's the idea.
So what does this deep dive mean for you? The core takeaway is that TJX delivered a textbook quarter. They proved the off-price model's resilience, its opportunistic buying, and they successfully expanded margins despite all the macro volatility.
The challenge, though, remains market perception. The company is performing beautifully, but that performance is simply demanded by its premium valuation. It leads to quick selling pressure when performance is merely excellent, not astronomical.
So here's the final thought for you to consider. Given management's profound confidence, their ability to grow both customer traffic and the average ticket at the same time, and that ambitious long-term store target of 7,000 global stores, Are we witnessing TJX transform from just a cyclical beneficiary of consumer trade down into a permanent structural compounder in global value retail?
And that structural shift, that's the fundamental question guiding the entire long-term investment narrative here. Thank you for joining us for this deep dive. We hope you feel thoroughly informed.
What nugget of insight stood out most to you from this call? We'll catch you on the next deep dive.